Very good evening to all of you. It's today lovely evening, lovely refreshing minds, weekends. We all together on this lovely platform, and with the kind blessings of Nanda ji, we always interact on this platform for the enhancement and enriching the knowledge bank. Before I would like to introduce CA Charanjot Singh Nanda ji and Anmol ji, I would like to brief on the functioning of CFMP. What is the CFMP and what CFMP is performing for the members of Chartered Accountants? CFMP is the Committee on Financial Markets and Investors Protection, provides suggestion on various bills, notifications, circulars, and other documents related to financial markets to the government and regulators. Besides this, the committee regularly interacts with MCA, RBI, SEBI, Insurance, Regulatory and Development Authority, non-finance companies, NBFCs, as well as forward markets, commission and stock exchange on the issues relating to financial markets and role of CAs and investors protection. This is the committee where we all put together our hands and enhance our knowledge by sharing the experience and enriching the members throughout India to enhance their knowledge. And the credit goes to our chairman, CA Charanjot Singh Nanda ji, who is always there to help the members. CA Charanjot Singh Nanda ji don't require any kind of introduction. It is like Suraj ko Deepak dikhana. Nanda ji is such a great personality. And one thing I would like to say, whenever you call to Nanda ji, he never pick your call. This is negative thing. But positivity, they don't want to waste your charge. They call you back after your ring switched off. He never forget to call you back, and this is the personality of Nanda ji. Hats off to you, Nanda ji, for always providing such a wonderful platform to interact with other members. It's his great personality and dedication. I have a big profile of Nanda ji, but due to paucity of time, we cannot take much time between the speaker and the audience. But yes, to maintain the decorum of the dais, we have to go with that. Charanjot Singh Nanda is a Central Council member of the 25th Council of the Institute of Chartered Accountants of India, and he is the chairman of DAP. At present, what the positions he is holding, he is the chairman of the DAP, Committee on Financial Markets and Investors Protection, ICAI, Committee on Information Technology of South Asian Federation of Accountants, that is SAPA. He is the vice chairman of the Board of Internal Audit and Management Committee of the Institute of Chartered Accountants of India. Position held by him during the term 2019-20 in the Central Council. He was the member from 2014 to 16 and 19 to 20. He holds the position of chairman of the following committees: Internal Audit Standard Board, Committee on Management Accounting, Committee on Internal Audit, Committee for Members in Industry, Women Members Empowerment, and he always promotes the women. He always says नारी शक्ति है और नारी की शक्ति ही हमारे देश को आगे बढ़ाती है, and they are sharing the burden of their families and putting the equilibrium between the personal life and the professional life. He is always on the front to promote the women in the industry as well as in practice. He is a member in the Committee for Cooperative and NPO sectors, Committee on Banking, Insurance and Pensions, Public Relation Committee, and so on. List is endless. At present, he is also the vice chairman of the committees of the Institute of Chartered Accountants of India, like Public Finance and Government Accounting Committee, Continuing Professional Education Committee, Banking, Financial Service and Insurance Committee. Again, list is endless. He is a member of the Quality Review Board set up by the Government of India, member of SEBI on primary market 2010 to 7 to 10, and Committee on Mutual Funds from 2007 to 2010, and pursues contributed as guest speaker at Survey Vancouver in Canada, British Columbia chapter of ICAI on IFRS, Effective Communication and Forensic Accounting Seminar. Has made presentations and shared sessions on the GST regime in India while making comparative analysis, overview of IAS 12 on income taxes, and overview of IAS 18 on revenue. So long. List is very long. But without wasting much time, this is over to Nandaji. I request you, please spread words of wisdom and experience and bless the members to encourage them and to come forward to have more and more speakers and lovely sharing of the knowledge among the participants so that more and more participants can join across the India and take the benefit of the great initiative taken by the Nandaji. It's over to Nandaji. Over to Nandaji.
Thanks a lot, Rituji. A very good evening to all. I can see CA Siddharth Vora here, see Animesh Singh, Mr. Shivam, technical support Akash, and all the participants have come here to go home on a late end. Ladies and gentlemen, I am truly honored to be amongst you. In fact, I am traveling. I am in Ludhiana for a convocation function, but I thought it fit to address you even for a minute. The basic impetus of Committee for Financial Markets and Investor Protection is to essentially create an environment where you will start getting involved with the financial markets. The latest change which we have made now, you are aware that SEBI is bringing out so many consultative papers. So now we have made it obligatory that Institute will answer all those exposure drafts on all the consultative papers. Ladies and gentlemen, this profession is today at the highest level. I'm reminded of a couplet which says, "Dete na the jo jawab, unke salam aane lage. Dete na the jo jawab, unke salam aane lage. Waqt badla, to mere neem ke ped par aam aane lage." Now, we have totally been engrossed in creating value and worth for the country. And gentlemen, the time has come when all of us should join together and create more professional opportunities in the capital market. Our capital market is very mature. SEBI is doing its role in the most effective manner. Regulation is fine, system is fine, financial prudence is fine. So times have come when chartered accountants who could perform are invited to the market. Let me tell you very candidly, I can confess that I know at least 700 to 800 people who earn more than 7 to 10 lakh rupees a day in the market. This huge money creation should come to chartered accountants, and I'm totally committed to it. And therefore, we have so many seminars. We have this seminar, plus we have the consultative paper. Last week, we had close to 3 meetings on that. So, ladies and gentlemen, be geared up for today's session. We have Mr. Anmol Rana, who hails from Ambala, now settled in Delhi, who would speak about social stock exchange. We have Mr. Siddharth Vora, who would speak on investments on hinge-to-end basis to create value. Siddharth also had a very wonderful strategy to make money. Both of us were together in Baroda, and I listened to his session very patiently to understand how perpetual money could be created in the market. So, not taking much of your time, I give the dais back to Rituji, and I would withdraw because I have another commitment. So, I welcome you all, and let us look forward. Let us do a lot of such programs in times to come. Thank you. Thank you so much.
Thank you so much, Nanda sir. Thank you so much. Now, we have CA Chota S. Srinivas. We would like to brief about CA Chota S. Srinivas. After that, Anmolji will deliberate the session. Welcome, CA Chota S. Srinivas ji. He is a BCom graduate from Bangalore University and a fellow member of the Institute.
Just a minute. I think Anmol Rana will speak first, I think.
Okay. Then we will introduce Anmol Rana ji first. Right, sir. I will. Sorry, sir. We would like to introduce Anmol Rana ji, today's speaker. He is a chartered accountant and he has done the certificate course in the concurrent audit of banks and the certificate course in the corporate social responsibility. He is the auditor, the NISM certified social auditor. Anmol Rana ji is a senior partner in Messrs. Anmol Rana and Associates. He has extensive experience of 14 years in bank audit, internal audit, statutory audit, tax audit, corporate audit, direct and indirect tax compliance. He was a special invitee of the Tax Committee of NIRC of ICI for 22-23. He has delivered webinars on NIRC of ICI and CPE Committee of ICI on social stock exchange and social audit standards issued by ICAI. He's a regular speaker on various CP study circles and public platforms for various topics like social stock exchange, social audit standards, CARO, bank audits, and UDIN. Last year, all of us faced a very big trouble while validating the UDIN. And that was a very, very great and helping hand extended by our member, CA Anmol Rana ji. He has vast experience in internal audit and statutory audit of private limited listed companies engaged in real estate, manufacturing, IT sector, textile, horticulture, animation studio, automobile, import and export, etc. Having experience in legal and financial advisory to various NGOs, charitable institutions. He is impaneled on various nationalized banks like State Bank of India, Punjab National Bank, Canara Bank, Central Bank of India, Union Bank of India, Baroda Bank, Indian Overseas Bank, UCO, Karnataka Bank, for various audits or inspections of banks and of its borrowers. With this, I would like to introduce CA Anmol Rana ji without taking much time. Welcome, sir. Thank you so much for giving me such a wonderful privilege to introduce. Thank you.
Thank you, ma'am.
So much.
Thank you, ma'am. Thank you. Thank you. Is my screen is visible now?
No, sir.
Just a moment. Now is that visible? Okay. Thank you. Thank you. So first of all, I would like to thank to the entire team of this committee for giving me this opportunity to deliver a session here. So today's our topic is social stock exchange. The last month also this committee has given me the opportunity to deliver the session on this topic. So again, sir has given me the opportunity to deliver a session here. So today again we will discuss all the opportunities. This is a very new topic in our professional colleagues. Social stock exchange. What is the social stock exchange exactly is, and how it will work, how it can benefit to the our sector like corporate sectors and the non-profit sectors and the social enterprises, what formalities they have to do, how they can get registered, what are their compliances, all we will discuss in detail. So without wasting any time, let's start our session here and let's discuss with us social stock exchange. So last time also, as I told, the word social stock exchange, the social stock exchange word is a very new word in our India. So I have given a tagline here is that is an electronic fundraising platform for social entities. So the word is here electronic fundraising platform. It means with the help of this platform, social entities can raise the funds for their needs to do their work, to do their project, whatever the social cause they are doing for their help. The government of India has launched the new concept, social stock exchange. So now, so next topic, next is introduction. So introduction means, first of all, when we listen this word in our country, so in the finance, in the finance budget speech of financial year 2019-20, our finance Mr. Srimati Nirmala Sitharaman ji first time used the word social stock exchange. At that time, she used the words like initiate steps toward creating social stock exchange, under the regulatory ambit of Securities and Exchange Board of India. It means it will work under the SEBI only. All the regulations will be issued by the SEBI. What is the purpose? For listing social enterprises and voluntary organizations. For their projects. What is the exact budget speech? What was the content in the budget speech at that time? That is the crux here. It is time to take our capital market closer to the masses and meet various social welfare objectives related to inclusive growth and financial inclusion. I promise to initiate steps toward creating an electronic fundraising platform, a social stock exchange under the regulatory ambit of SEBI for listing social enterprises and voluntary organizations working for the realization of a social welfare objective so that they can raise the capital as equity, debt, or as units like mutual fund. And here. So it means the word social stock exchange with the help of these words like NGOs, social entities can raise the fund. So what is the next topic is here? International. Social stock exchange globally. What was the history and behind the social stock exchange? What is the status? So in the international level. Before India, when we heard the social stock exchange first time in India, the word social stock exchange has already been introduced in the various countries of the world. Which are the countries? The countries are Canada, Jamaica, Singapore, Brazil, Portugal, South Africa, and the United Kingdom. All the 7 countries, the social stock exchange is working there. But here is the update that out of these 7 countries, first 3 countries, Canada, Jamaica, and the Singapore, only in these 3 countries, the social stock exchange is working effectively. And the other 4, Brazil, Portugal, South Africa, and the United Kingdom, in these countries, social stock exchange is here available, but not functionally working with effectively. So after the 3 countries, Canada, Jamaica, and Singapore, in our country, in India also, there is the latest update that in India also social stock exchange has been started working. So we will discuss in the later portion there how it is working on our social stock exchanges. Here. Next. The very important is what is the need of the social stock exchange? What is the idea behind the social stock exchange? Why the government of India think to bring the social stock exchange concept? So all of we are very much known about that. The first of all, economic damage by the COVID-19. Economic damage by the COVID-19. During the COVID-19 pandemic, most of the persons, not only in India, all over the world were affected. Economic damages, more the person, their salary was not available, they have to survive. There were survival issues also. To meet out these issues, so there is a requirement. Our government, central government and the state governments did their work very, very effectively. They done the tremendously job, but along with that, the resources are limited. So all the general public, including the NGOs and the other sectors, came together and worked for the government, for the people, to bring out of this pandemic. So, but idea was that whenever we have to do something, we need the financial help. Financial constraints are always there. So whenever we do the work for the social cause and anything, financial stability we need strongly. So only for that, it is the idea that to unleash unlock the large pool of social capital and enabling commercial capital to the partner with the social capital. It means corporate sectors and the NGOs can come together, they can meet and do their fulfillment, the needs of the each other. Next, journey of the social stock exchange. Journey of the social stock exchange means on 5th July 2019 budget speech. First of that, as I earlier told, in the budget speech of 1920, our finance minister first time used the word social stock exchange. So after that, in September 2019, 19 September 2019, it was the constitution of the working group was done. And in September 21st, 2020, constitution of the technical group was also done. And after that, all the working committee group did their work and the technical committee persons did their work and they submitted their reports to the authorities. So on May 2021, first report was received of the technical group, and in the month of June 2021, report of the working group also has been submitted to the authorities. And on the basis of their reports, the SEBI has issued some of the notifications, regulations through the Gazette. After that, they did the framework also. SEBI has also issued a framework via circular in September 2022. All the circulars and the Gazette notifications was issued at that time. We will discuss in detail in our topic. So later on the December, in the last of the month of December 2022, final approval was given to the BSE to systematic do the final things and work for the social stock exchange. And in March 2023, final approval to the NSE was also given. Next. As I earlier told, in July 2022, SEBI issued some of the regulations. What was that? ICDR requirements, third amendment regulation 2022. They did the amendments at that time and introduced some of the regulations. So different chapters were introduced. Chapter 10A, chapter 9A was introduced to regularize the social stock exchange world. Next is, so first, as I told, chapter 10A ICDR regulations were introduced in between chapter 10 and 11. Chapter 10A was introduced with the sum of the regulations. The first regulations is 292A. 292A definition is regulations is about the definitions. What is the definitions? What are the definitions for whole concept? What is the social enterprise, social stock exchange? What are the different terms and how it will be treated, how they will work? All the things are mentioned under the definition chapter here. So first we will discuss social enterprises. Social enterprises means either not-for-profit organization or for-profit organization. That means the eligibility criteria. What that mean? Earlier in our mind, it was clearly mentioned that not-for-profit organizations are only the organizations, they work for the social cause. But here all the for-profit organizations are also who meet the eligibility criteria are covered under the word social enterprises. It means with the non-profit organizations, for-profit organizations can also be eligible for social enterprises. Yes. The next is social stock exchange. Social stock exchange means separate segment, a recognized stock exchange having nationwide terminal permitted to register NPO or list securities issued by the not-for-profit organization. It means social stock exchange is a separate segment. It is not a separate exchange. It will work under the BSE or the NSE. NSE and the BSE had issued a separate segment. By with this, NGOs can list their securities and do their work. Next is very important, not-for-profit organizations. NPO means social enterprises, which is any of the following. What are the issues? First one, charitable trust. Next is societies registered under 1860. And the third one is company incorporated under Section 8 of the Companies Act 2023. Any other entity may be specified by the board. At present, only these three are here, but after that, board may be introduced any other entity, maybe on the later stage. But here, at present, trust, society, and the Section 8 companies are covered under this head. Next is for-profit social enterprises. For-profit social enterprises means company or a body corporate for profit, which is social enterprises, does not include a company incorporated under Section 8 of the Companies Act 2023. Important is here, for profit social enterprises, only the body corporates operating for the profits are covered here, not the Section 8 company. Why? As the Section 8 company has already been covered under the area of not-for-profit organizations. Next is fundraising document. Fundraising document means fundraising document, draft fundraising document, and the final fundraising document. These documents will be called as fundraising document. Next is draft fundraising document. What is the meaning of draft fundraising document? It means the draft fundraising document filed with the social stock exchange in relation to the public issue of zero coupon, zero principal instrument. We will discuss in detail what is the zero coupon, zero principal in the next our session. So by the not-for-profit organizations registered here. Next definition is final fundraising document. What is the final fundraising document? It means final fundraising document filed with the social stock exchange pursuant to incorporation of observation issued in respect of draft fundraising document by the social stock exchange. It means whatever the observations are issued by the SEBI or what are the observations issued by the exchange, social entities, social organizations has to incorporate all these observations in their draft fundraising document and finalize their document. Only then after they can issue the final fundraising document. Next, very, very important for our professional colleagues, the word is social auditor. What that mean? That mean an individual registered with self-regulatory organizations as may be specified by the board who holds a valid certificate as qualified a certification program conducted by SRO as specified by the board. Here is the update that ICAI has made a special other organization. It means ISAI, Institute of Social Auditor of India. Empanelment for the social auditor has already been started. Many of our professional colleagues has already been empaneled on social auditor platform. So the basic idea is that NSIM is conducting the examination. First of all, our colleagues has to clear that exam. Only then after they can enroll as a social auditor at ISAI. So next definition is social audit firm. What that means? Social audit firm means any entity which has employed social auditor and has a track record of minimum 3 years for conducting social impact assessment. It is important here. The minimum 3 years condition is already mentioned here in the law that it is very important. First condition is the firm has to employ social auditor, and the next is the person has the minimum 3 years of experience of conducting social impact assessment. Now, earlier We have covered regulation 292A. Now we will discuss regulation 292B. What is that? Applicability of provisions. Applicability of provisions. This is covered also regulation 292B of the chapter 10A ICDR regulations. What is that? Whom all these provisions will be applicable? Number one, not-for-profit organizations seeking to only get registered with the social stock exchange. All the not-for-profit organizations who want to only register with the social stock exchange, all the provisions will be applicable on that. After that, not-for-profit organization seeking to get registered and raise funds through social stock exchange. It is the very basic condition that if any of the social entity, not-for-profit organizations want to raise the fund, first of all, they need to get registered with the social stock exchange and all the provisions will be applicable on that organization. Next is for-profit social enterprises seeking to be identified as social enterprises under the provisions of this chapter. All the provisions will also be applicable on those for-profit social enterprises who want to be registered as social enterprises, who want to be identified as social enterprises. All these provisions will be applicable on these organizations. Next is regulation. We have done regulation 292A, 292B. The next is 292C. What is that? Access to social stock exchange. What that mean? A social stock exchange shall be accessible only to institutional investors and non-institutional investors. It will be covered institutional investors and the non-institutional investors both. Any other class may be specified by the board by any time, but at present only these two types of the investors are covered: institutional investors and the non-institutional investors. Our next regulation is 292E. That is the base of that social stock exchange concept. So we will discuss here. It is point by point, in brief, in detail. So very important. All of our colleagues need to listen this regulation 292 here. The first condition is that for regulation 292E, for the purpose of these regulations, a not-for-profit organizations or a for-profit social enterprises to be identified as social enterprises shall establish primacy of its social intent. Very important. All these not-for-profit organizations and for-profit social enterprises all will be covered, but important is their intent should be social. So how their intent, how we can check their intent is social? In order to establish the primacy of the social intent, such social enterprises meet the following eligibility criteria. What are these eligibility criteria? Here are the next. All the social enterprises shall be included in at least one of the following activities. What that mean? Here are the 16 activities are mentioned here. Out of these 16 activities, if not-for-profit organizations and for-profit organizations are doing any of the following activity, with doing this activity, the first condition of social intent will be covered. What are these 16 activities? We will discuss here. First one is eradicating hunger, poverty, malnutrition, and inequality. Next is promoting healthcare, including mental health care, sanitization, making available safe drinking water. Next is promoting education, employability, livelihoods. Next one is promoting gender equality, empowerment of women. Next is protection of national heritage, art and culture. Very next is training to promote rural sports, nationally recognized sports, Paralympic sports and Olympic sports. Next is supporting incubators of social enterprises. Very next is supporting other platforms that strengthen the non-profit ecosystem in the fundraising and the capacity building. Next is promoting livelihoods for the rural and urban poor, including enhancing income of small and marginal farmers and workers in non-farm sector. Next is slum area development, disaster management, including relief, rehabilitation, promotion of financial inclusion, facilitating access to land and property, assets, bridging and digital divide in the internet and the mobile phone access, promoting welfare of the migrants and displaced persons. Out of these 16 activities, if any organization, not for profit or for profit organization, is doing any of the one activity, so it can do more than one activity also here. But the basic idea is that at least one activity should be done by the not-for-profit organizations to be identified as social enterprises. First condition. That is the first condition. What is the next condition? Here is the next condition. Next condition is social enterprises shall target underserved or less privileged population segments or regions recording lower performance in the development priorities of central or the state governments. It means social enterprises has to work for the underserved or the less privileged population segments. Very important. What is the next and the third condition is? Third condition is 67% of the activities. So it is also very important to check these conditions. Out of the three conditions mentioned here, at least one of the following conditions need to met by the social enterprises who be identified as social enterprises. What is that? The first condition is at least 60% of the immediately preceding 3-year average of the revenue should be come from eligible activities to the members of the target population. Next is 67% of the immediately preceding 3-year average of the expenditure has been incurred for providing eligible activities. Next is member of the target population to whom eligible activities have been provided constitute at least 67% of immediately preceding 3-year average of the total customer base. Social enterprises should meet any of the one condition behind that. They can meet more than one also, but at least one condition they have to fulfill to be identified as all the three conditions for the social enterprises. What is the next? Eligibility conditions we have discussed, but which type of the organizations will not be eligible to be identified as social enterprises? What are here? Number one is corporate foundations. Next is political or religious organizations. Next is activities, professional or the trade associations. Next is infrastructure and housing companies. Here are the exceptions, except affordable housing. And all these organizations will not be identified as social enterprises. Next. So before that, 292E regulation was covered. Now the next regulation is 292F. What is that? Requirement relating to registration for a not-for-profit organizations. What is the what are the requirements here? Number one, not-for-profit organization shall mandatorily seek registration with the social stock exchange before it raises funds through the social stock exchange. Very important is that if any of the not-for-profit organization want to raise the fund from the social stock exchange, first of all, the not-for-profit organization mandatory have to seek registration with the social stock exchange. That is very important. But here is the provided that if not-for-profit organizations may choose to register with the social stock exchange and not the raise funds through it. It may choose the option that they can only want to register, maybe or may not be, want to raise the funds from their social stock exchange, but they want to register also here, they have to register. Next is minimum requirement for the registration of the not-for-profit organization of the social shall be specified by the board time to time. What are these requirements? We will discuss next. What are the minimum requirements to be met by the not-for-profit organizations for registration? What is that? As I mentioned in the previous slides, that framework was issued by the SEBI circular in 19 September 2022. The framework told us that what are the minimum requirements to be met by the not-for-profit organization for the registration. What are that? Number one, trust society section 8. The organization must be trust society or the section 8 before the registration. First condition is only that. Next is disclose if NPO is controlled by the government or the private. Next is NPO must have a valid certificate under section 12A, 12AA, 12AB. This is that. Next is does not have a notice or ongoing scrutiny by the income tax. That is also covered here. It is very important condition that does not have a notice of the ongoing scrutiny by the income tax. If any of the scrutiny, if any of the notice has came to the organization and the scrutiny is ongoing, then it will not be eligible to register their organization at social stock exchange. Very important here. If they want to get registered at the social stock exchange, they have to complete first of all their assessment. They have to reply all their notices. Only then they will be eligible for this condition. They will be eligible. Next is valid IT PAN they must have. The next condition is minimum 3 years old. The organization must be minimum 3 years old. Next is having valid 80G exemption certificate. Next is compliance of regulation 292E. What was the compliance? As we have discussed in our previous slides, what are the 3 conditions? First one is it should be a social intent. Next is the organization must work for underprivileged, underserved people, target segment. Next is the 67% their condition. So compliance of regulation 292 is also very important. Next is minimum annual spending in the past financial year must be at least 50 lakhs. That is very important. And the next is minimum annual spending in the past financial year must be at least 10 lakhs. So at least 10 lakhs should be spent. Spending is 50 lakh and the annual funding is 10 lakh. That condition should also be fulfilled by the organization. Next is how they can raise the funds. What are the instruments available for the not-for-profit organizations and the for-profit social enterprises? That is governed by the regulation 292G of the chapter 10A of the ICDR regulations. What is that? Not-for-profit organizations. One is ZC, ZP instrument. We will discuss in detail in our coming slides. Next is donations through mutual fund schemes. That is important. For profit social enterprises, what are the instruments available? Either equity or the debt securities. They can raise their funds with this. Next regulation is 292H of the chapter 10A. What is this? Ineligibility for raising of the funds. Earlier we discussed what type of the organizations can cover to register themselves and which of the organizations are not eligible. Now we will discuss here ineligibility for raising of the funds. It means which type of the organizations are not eligible for raising funds through the social stock exchange. Here, if the social enterprises, any of its promoter group or director or selling shareholders or trustee are debarred from accessing the securities market board. But if it means any of the promoter group, the director, for them they SEBI and divided them for raising the funds, the social enterprises automatically will not be eligible for raising the funds. B condition is if any of the promoter or the director or the trustee of the social enterprises is a promoter or director of any of the company or social enterprises which has been divided from accessing the securities market by the board, then they also will not be eligible for raising the funds. Next is willful defaulter. If any of the organization is already a willful defaulter, they have already been declared as a willful defaulter, they will also will not be eligible for raising the funds. Next is economic offender. If any of the promoter or directors of the trustee are economic offender, these type of the social enterprises will also be not eligible for raising the funds. Next condition is that if social enterprises or any of its promoter or directors or trustees has been divided from carrying out of its activity or raising funds by the whom? MHA, Ministry of Home Affairs, or any other ministry of the central government or the state government or charitable commissioner or any other statutory body. If it has been divided by any of the government authority, any of the ministry of the central government, then they also will not be eligible for registered or the raising funds through the social stock exchange. Now, the word ZC, ZP, we listened in the previous slides. What are these? What is the meaning of ZC, ZP? Zero coupon, zero principal. Regulation 292I explains about the issuance of zero coupon, zero principal regulation. What are the regulations? Zero coupon, zero principal instrument shall be issued only by a not-for-profit organization. It is very important. It can be issued by only the not-for-profit organization. For-profit organizations cannot issue. So it also important is that shall have a specific tenure. The important is specific tenure. It should be for the specific time frame. So next is important as the meaning mentioned in the name also, zero coupon, zero principal. It should be issued without any coupon and no principal amount shall be payable on its maturity. At the time of the maturity, no coupon will be given and the no principal amount will be refunded to the for the giver. Next, regulation 292J says that only a specific project or the activity to be completed within the duration specified in the fundraising document. Important is if the fund has been taken for a particular period or a particular project, it should be completed within a duration specified in the fundraising document. Let's suppose in the fundraising document, you have mentioned if you want to build a building either for a charitable purpose, if you have raised for the funds for that particular purpose, then you have to use all these funds only for that project only, and all that activities should be covered, should be finished within a time frame given in the fundraising document. Next is procedure for issuance of ZCZP. Earlier we discussed what are ZCZP conditions, and now regulation 292K says explain about the procedure for issuing the ZCZP. It means how ZCZP can be issued by the not-for-profit organizations through social stock exchange. What is that? First procedure is that, first of all, not-for-profit organization, they have to submit a draft fundraising document with a registration application form and along with the specified fees to the social stock exchange. They will submit a draft fundraising document along with all the annexures, all the documents required to the social stock exchange. Only then that is the first basic step. And after that, the draft fundraising document shall be made available on the website. On the website, the social stock exchange and the not-for-profit organization, they will have to publish on their website the draft fundraising document for at least 21 days period for public comments. So that if any of the person from the general public want to comment, want to raise any of the issue, want to raise any of the query regarding issuance of that project, that issue, they can raise, they can do their comment. So only that for purpose, it should be available on the portal of the social stock exchange and the not-for-profit organization or within the 21 days period. Next is the social stock exchange shall provide its observation on the draft fundraising document to the not-for-profit organization within 30 days from the filing of the draft fundraising document or receipt of clarification, if any, sought by the social stock exchange from not-for-profit organization, whichever is later. What does that mean? It should all the observations, whatever the observation have been received by the social stock exchange, they have to issue a final clarification and the observations within the 30 days to the not-for-profit organization. So after receiving the observations from the social stock exchange, not-for-profit organization shall have to incorporate all these observations in the draft fundraising document and file a final fundraising document with the social stock exchange prior to opening of the issue. Before listing, they have to submit a final fundraising document. And what is the final fundraising document? The draft fundraising document. In that document, they have to incorporate all the observations. What are the observations? What are the issues are there? They have to incorporate. Only then they can raise the funds. Next. The next is minimum disclosure requirements for not-for-profit organizations raising funds through issuance of ZCZP. What are these regulations? Here, social stock exchange, under the guidance of social stock exchange, governing council shall mandate the structure of draft fundraising document, final fundraising document, shall host all the requirements on its website. It means social stock exchange, they have to host all the what are the structure of the draft fundraising document and the final fundraising document. They will provide on their website. They will have to host. So what are the minimum disclosure requirement for the NPOs through the draft fundraising document? What are the minimum disclosure requirements? These are the minimum disclosure requirements. If any of the organization, not-for-profit organization, want to mention, want to declare more than that, they are very much welcome. But these are the basic, these are the minimum disclosure requirements they have to fulfill before using the funds. What are these? First one is vision. Vision should be clear. Organization activities. Under the vision topic, organization activities, they have to declare what activities they are doing how they are working, what are their organizations, structure, intervention and the programs are in line with the aim of the object of the stated in their constitution. The basic idea behind that is all the information they have to mention so that investors can check what are the objects of that organization and what are the programs they are doing, what type of the activities and where they are doing. Next is target segment. Organization has defined its target segment and reached to accomplish its planned activities. Next is clear identification and understanding of the target segment, those affected by the problem and how they are affected. That they also have to mention clear. The NPO must disclose how its approach intends to improve inclusion for its customers or recipients. They need to clearly mention what are the issues they are going to face and what are the solutions available with them, what type of the population target segment they are going to work for that, what are their issues, what are their problems and how they are effective. That should be clearly mentioned in their draft fundraising document. Next is strategy. Strategy formulation towards accomplishing vision should take into account capabilities and learning from challenges. They have to also clear what strategy they are having about their working. Next is governance. Organization has a governing body and details of its governing body, composition, dates of board meeting held, they have to mention. What are the structure? What are the person behind that organization? They clearly have to mention. Management. Now, the important is details of the key managerial staff. What are the key managerial staff? In charge of the programs, fundraising, marketing, finance, HR, all these persons, details of all these persons should clearly mention here. Organization should disclose whether it provides letter to the staff and voluntary defining roles and the responsibility. They have to clearly mention. As a periodic performance and the appraisal process also, about this information they also have to disclose. Next is operation. Physical existence, complete address of the sites of the programs. Physical existence means at which places, at which area of the country they are working, with the complete address of their sites and the programs. They have to clearly mention what exactly they are doing and at what place they are doing. They have to mention their address also here. Next is finance. Finance means disclosure of the financial statements for the last 3 financial years and in accordance with the guidelines issued by the ICAI for NPOs. What that means? About all the last 3 financial years, they have to submit what are the financial statements, and all these financial year statements should be prepared as per the guidelines issued by the ICAI for the NPOs. Importantly, they have to check whether all the financial statements are as per the guidelines, proper guidelines issued by the NPOs or not. Important. Next is compliance. In compliance part, annual accounts of the last 3 years are audited. Important is the last 3 year accounts should be audited. There are no material qualification or material irregularities reported by the auditor. They have to check compliance with respect to notice. The income tax received, they also need to declare. Next is credibility. Credibility. For the credibility, what documents are required? Documents as registration, trust deed, MOA, AOA, address proof, IT PAN, 12A, 12AA, 12AB, certificate FCRA, and returns. They can declare. Remuneration to the governing members also, they can clearly mention. Next is social impact. That is the new terminology. social impact of the past programs undertaken by the organization. What that mean? If organization has undertaken any of the program in the previous years, what are the issues, what are the impact, what target segment, all the information about the impact of the social impact, they have to given here. Risk. What does this mean? Risk that the NPO sees to its work and how it proposes to mitigate this. If we know we want to do any of the work, there may be some of the issues along with in line of that. NPO should also clear what type of the risk they can face while doing their work and what are the possible solutions are available with them, how they can mitigate this. They must have clearly mentioned this document. Unintended consequences that NPO sees from its work and how to propose mitigate. I mean, it is clear if any NGOs thinks that while doing their work, they may face a challenge, they may face a type of the activity, they may face any of the disturbance. So they must ready for that type of activity, how they will overcome with that. Next is other conditions relating to issuance of ZC, ZP. ZC, ZP instruments shall be issued in dematerialized form only. Important is that here ZC, ZP should be in a dematerialized form. It cannot be in a physical form. So it is clear it is in the demat form only. Next condition is that minimum issue size shall be rupees 1 crore. That is the important condition for the ZCZP. The ticket size should be 1 crore. So if any of the organization, not-for-profit organization, want to raise the fund, their project must be for the 1 crore, minimum of the 1 crore. Only then they are eligible to raise the funds, to raise the ZCZP. If that is below 1 crore, on that these projects will not be eligible for raising funds to the ZCZP. And the next also very important condition is the minimum application size. The minimum application size shall be rupees 2 lakh. It shall be rupees 2 lakh. Below that, nobody can apply for that. Next important condition is minimum subscription should be achieved shall be 75% of the fund raised. Important. NGO, if want to raise the funds to the ZCZP for their subscription, condition is that minimum 75% should be achieved. In case 75% are not achieved, what are the conditions? If 75% are not achieved, all the money should be returned back to the investors. If it is more than 75% but not the 100%, what are the issues? Next we will discuss. Next, in case of any of under subscription, not-for-profit organization shall in the fundraising document provide the following details. Here, if not-for-profit organization seeks, they are not eligible, they were not going to meet the fund subscription, full subscription, they have to provide these details. What are these details? In case the subscription amount is more than 75% but less than 100%, so in that case, what are the sources available with the non-for-profit organizations for raising the funds? They need to clearly mention what are the sources available, how they will arrange the balance amount of the capital for their work. Next is possible impact on achieving the social objectives in case such under subscription is not arranged. Here, In case of the shortage of the funds, how their objectives will be impacted, how they will overcome with that. Next is provided that funds shall be refunded in case of subscription is less than the 75%. That is already mentioned. If the subscription is below 75%, all the amount shall be refunded. Not a single money will be used. Next is termination of listing of ZCZP. What is the termination? Termination means the object for which the funds were raised has been achieved and a certificate to the effect is submitted to the social stock exchange. It means when the object of the purpose has been achieved and the certificate has already been submitted, it means termination of the listing of ZCZP. First condition is achieving the object. Next, second condition is tenure. It should be for the specific time frame. If the time has been expired for that particular project, it will automatically will be terminated. Earlier, we have discussed chapter 10A. Now we will discuss obligation of the social enterprises under chapter 9. That was also issued on 25th July 2022 under the ICDR LODR regulations. Disclosure requirements. Disclosure requirements, obligations. What are the obligations not-for-profit organizations, social enterprises are to do? Now, whose designated securities are listed shall comply with the disclosure requirements required to make annual disclosure within 60 days from the end of the financial year. From the end of the financial year, within 60 days, they have to make their disclosures. Regulation 91C of the framework in detail tells us about what are the annual disclosures, what are the expectations from the board, what minimum information they want in their annual disclosures. Here we will discuss. First one is disclosure on general aspect. What is that? Disclosure on general aspect is that name of the organization. Name means legal and the popular name. Here is legal name is also they have to mention, and the popular name also they have to mention. In some of the cases, we also know that popular name is different and the legal name may be different for the organization. So they have to clearly mention legal name and the popular name. Next is location of the headquarters and the operations. They need to mention details of the headquarters, where the office are located of the organization, and details of their operation. At which place, which site programs are running, they need to give clear detail. Next is vision, mission, and purpose. Vision, mission, and purpose. What are the basic vision of that organization? What are the purposes? They need to mention. Also, organization goals, activities, product, and services. What type of the organization goals they have, activities they are doing, what are the services they are rendering, they clearly need to mention in their annual disclosures under general aspects. What are the next? Outreach of the organization. It means type of and number of the direct and indirect beneficiary stakeholders they need to mention. Next, scale of operations, including employee and the voluntary strength. How much number of the employees they are having for their work, and also voluntary strength they need to give. What are the voluntary strength they are having? They need to clearly mention. List of top 5 donors or the investors budget wise, they also need to clearly mention. List of top 5 intervention programs on the budget wise, they also clearly need to give. Earlier we discussed about the general aspect. Next disclosure is for the governance aspect. Governance aspect means ownership and the legal form, Next is governance structure, outline board and the management committee structure, mandates, membership, charter, policies, and the internal controls. Details of the governing body, including names of the members of the body. Next is executive with the key responsibilities. About that, they need to clearly give the details. Next is disclosure about the number of meetings by the governing body and the committees formed by them, along with the attendance and the process of performance review. They need to give organization level potential risk and the mitigation plan, reporting of the related party transactions, mechanisms for advice and concerns about ethics, along with the conflict of the interest and communicating other critical concerns. It means all the information about their organization they need to give at the level different. If they are having the related party transaction, they also need to give. If they know any of the conflict of the interest, then they also have to give their detail. Also, remuneration policy of the governing members, stakeholders, grievances, process of grievances redressal, and number of grievances received and resolved also they need to give. Compliance management process, the statement of compliance from the senior decision maker. Organization registration certificate and other license and certifications also they need to give. Now, next is disclosure about the financial aspect. What about the financial aspect? They need to give financial statement. What are the financial statement? Balance sheet, income statement, and the cash statement. Also, program-wise fund utilization for the year. Next is auditor's report and the auditor's detail. Audit report they have to give and the detail of the auditor, like name, address, and the contact details of the auditor, they clearly need to give along with that document. Next regulation is 91D of the chapter 9A. What about that? Intimation and disclosure by the social enterprises for the events or the information. It means if any of the material event they have, for that they need to clearly mention. They first of all they need to clearly make a policy for material events. That policy shall be duly approved by the board or its management. The organization shall mandatorily have a policy for determination of materiality, and this policy should be duly approved by the board. What are the next? Board management shall approve one or more of its 3 managerial person. In the policy, they have to mention the designation, they have to mention the details. What are the key manager persons who will be responsible for determining the material events or the information and making disclosure. So it is clearly in the policy should be clearly mentioned that who are the responsible person for doing the compliance of that regulation. Contact details of such person shall also be disclosed to the social enterprises. In contact details like name, mobile number, email ID, they have to clearly mention about this. Next is shall disclose. The key managerial person shall disclose any event that may have the material impact on the planned achievements of the output or the outcomes. They need to clearly give. And also shall be made soon as possible but not later than 7 from the occurrence of the events from the detail. They need to give. And the steps taken by the social enterprises to address the same. The important is within the 7 days, if the person is having the information that there is a material event which may create a problem for their project, all the information regarding that material event they have to give to the stock exchange within 7 days, not after the 7 days. shall provide updates on the regular basis. It is important that they need to give the update on the regular basis. It is not like that they have given the detail on the first time, not after that. What are the regular updates? It can be given by the fortnightly, it can be given by the monthly. It depends on the basis of their quantum of their project and the quantum of the materiality, along with the relevant explanations till the time it remains material. Till when they have to give all the details, till the time it remains material. Social enterprises shall provide specific and adequate reply all the queries raised by the social stock exchange with respect to event or the information. Social enterprises suo motu confirm or deny any reported event or the information about the social stock exchange. Social enterprises shall disclose on its website all such events or the information disclosed to the social stock exchange. They need to give. Now we will discuss the next regulation 91E of the chapter 9A. What is that? It will discuss about the social impact report. What is that? Social entities which is either registered or raise funds. The important is here either registered or raise the funds. It is not mentioned that if the entity has raised the funds, then they have to give the detail about the social impact report. If the entity has not raised the fund, but it has been registered on the stock exchange, they importantly have to give detail about the social impact report. Shall submit an annual impact report in the format specified by the social stock exchange time to time. They can issue the format time to time. Annual impact report shall be certified by the social audit firm employing social auditor. They can also give the detail about their impact report. Next is they have to give the detail about the annual impact report within the 90 days from the end of the financial year. The important time frame is within the 90 days they have to give. And AIR shall capture quantitative and the qualitative. Both qualitative and the quantitative aspects should be covered under this report. In case any NPO is only registered without listing, important is that if without listing it is registered, in that case also AIR must be covered NPO's significant activities, intervention programs of the projects during the year of intervention. In the past years, if the organization has not raised the funds, they have only registered. In that case also, if the organization has done any of the activity, any of the program, this AIR should cover all the significant impact of these activities. Next is strategic intent and planning. AIR should cover minimum the following aspect. What are that? Social or environmental challenge is addressing has changed in the last year. If there is any change with comparative to the last year, they have to give information about that. Also, challenge or the planning. What are the challenges and the planning? This should also be mentioned. If there is a change in comparison to the previous year, they can also mention. What are the target segment? What are the target segment? Who is being impacted? About that also they need to give the information. Has this change in the last year? About that also they have to give the detail. What will be the outcome activities? Disclosure should give the positive and the negative. It is underlined here that negative outcomes should also be mentioned in the annual impact report. It is not about the positive impact. It is also about the negative impact. If organization is running any of the project with this project, if any negative outcome is there in the society or the persons, they need to cover the negative outcomes also along with that in their report. Approach. What is the approach? There should be a baseline status at the start of the activity, at the end of the last reporting year. There should be a material change in your implementation model in the last year. They also need to give and brief out of the alignment. What are that? It should be in alignment with the social development goals that should be there. And the last year, what we have seen the biggest risk to achievement of their desired impact and how these are mitigated. What are the challenges they have faced and how they have mitigated about that. All the information should be given in the annual impact report about this. Impact scorecard, what are the matrices they have, what are the narratives they have, what are the beneficiary stakeholders, validations to the survey and the other feedback forms. They can get the information about their project through the survey and the feedbacks forms by visiting in the target areas and the target segment people. With using the feedback forms, they can get the information, what is the major impact, what type of information they are getting. They can use that information in their annual impact. The last one is a statement of the utilization of the funds. Regulation 91F says about the utilization of the funds. It means social stock exchange, any of the social enterprises registered here need to give utilization of the fundraise, details of the certificate of that on quarterly basis. By when? Within 45 days of the end of the quarter. What they have to give? Category wise amount money raised, category wise amount of money utilized, balance amount of remaining unutilized. It means how much money they have raised, how much money they have utilized, what are the balance amount available, they need to clearly mention in their statement. Also, unutilized amount shall be kept in a separate bank account and shall not be commingled with the other funds. Important is here. Next is, as I told, in our India also, now social stock exchanges are live here. What are these platforms? If you want to visit to the NSE platform, you need to visit the website here, nseindia.com/ssc. Using that site, you can go get all the information regarding the social stock exchange through the NSE portal. And what about the BSE social stock exchange.com? BSE portal, they are having BSE social stock exchange.com. All the information about their BSE platform, all the information available on that platform. Using these two links, you can get the information about all the information. What are the basic requirements, how they can get registered, what are the organizations they have already been registered. They can get the information using that information. And we have the time for the 2-3 minutes or no?
Yes, sir. Yes, sir. We have more 2-3 minutes for Anmolji.
Okay.
Sir, it is concluded by Anmolji.
Ma'am, need to wait for a minute. Huh?
Okay. But it is really wonderful.
Is it my screen is available, visible?
Your screen is, yes. Now it is available, sir.
Yeah, that is the NSE social stock exchange. Someone, ma'am, can you mute yourself? Yeah. So That is the social stock exchange portal of the NSE India. Using that platform, all the information is mentioned here. What is the information? If you want to go through about the eligibility criteria, you can visit the eligibility criteria link. About the SSC, you can get the information about the SSC. If you want to get the information benefits of the registrations, you can go through the link. That is a improved market access, synergy between investors and the investees, performance, all this information. If you want to check what are the information which registered NGOs, what are the registered NGOs that right now they have registered themselves, click on the link registered NGOs. You will get the information about that. What are the how much NGOs already have been registered on the social stock exchange. These are the information about all these NGOs. Number one is Gramalya Trust. They are the number one through the NSE portal. Their date was registration was 5th April and the validity of their registration is for the 1 year, 4th April 2024. So like that, you can check how much organizations have already been registered on the social stock exchange. Till now, 13 NGOs have already been registered on the NSE platform. The last registration on the NSE platform for the Ratna Nidhi Charitable Trust, they have registered themselves on the yesterday also, 26th May 2023, and their registration is valid till 25th May 2024. So using that platform, you can visit, all the information is available. If any of the query of any of the members is have, now we can take the query of our members.
May I join it, sir?
Yes, ma'am. Yes, ma'am.
First of all, Anmolji, I would like to extend my sincere thanks from the bottom of my heart that the session was really very beautiful, and the sections which you elaborated very well, section 92, E, G, H, I, it was so well and beautifully framed in your PPT that we are really amazed how hard work you have put, and it is really shown from your deliberation, from your PPT, sir. Amazing. And the
Thank you, ma'am.
many members who got the information from the links which you have shared with all the members. It is stuff which is provided ready to eat. Thali mein dal diya bhaiya, kha lo, paros diya, kha lo. It's wonderful session, sir. I have never seen such kind of session in which so much information is forwarded to the participants. But there is one question from the participant regarding the minimum expenditure of rupees 10 lakh. They want to get it again, sir.
Yes, ma'am. The basic, just a moment, ma'am. Yeah, there is a condition that minimum annual funding in the past financial year should be at least 10 lakh. And the another condition is minimum annual spending in the past financial year must be at least 50 lakh. So it means that in any of the organization want to get registered on their platform of the social stock exchange, their minimum spending should be at least 50 lakh in the past financial year. That is the basic idea.
50 lakh spending means it will be certified by the auditor also?
No. Financial statement should be certified by the auditor, but when you will check the income and the expenditure side, the expenditure should be 50 lakhs in the last financial year. Minimum, that is the idea.
Minimum expenditure should be 50 lakh in order to register for a stock exchange, right, sir?
Exactly.
And the funding of rupees 10 lakh from where, sir?
Funding can be, it is the minimum. It can be more. It can be 50 lakh, it can be 1 crore, but the basic idea is that funding should be from their basic activities, as we covered in the 67% condition. Funding should be from their basic activities, what they are doing. It should be from there. At least 10 lakhs. It can be more.
Sir, the clause which you have mentioned in the PPT regarding the disclosure requirements, the topmost 5 donors, is it correlated with that or not?
The topmost 5 donors, the information they need to give, what are the top 5 donors, what are the top 5 projects they are doing, they need to give in their annual information, annual disclosures.
Okay, sir. Okay, sir. These are the 2 points which were requiring to be correlated. That's why we asked you. Thank you so much. Can you share this PPT with us, sir? Hello.
Yes, ma'am. Yes, ma'am.
Sir, we request you to share this PPT with us for the benefit of members.
Sure, ma'am. Sure.
Will it you write to the DAB or to directly to us?
Yes, ma'am.
Will the PPT will be shared by you to DAB committee or to us, sir?
Yeah,
CFMP?
definitely. I will share to the Nandaji or the giver. We will inform you about that. They will give you.
Thank you so much, dear brother. I will say, dear brother, God bless you. Have many more sessions from your side for the betterment
Definitely,
and enlightenment of the members. Thank you so much, Ji. Thank you from the bottom of my heart.
Sure, ma'am. Thank you. Thank you.
Thank you. Thank you. Now it's the time to introduce Siddharth Vasuji. Siddharth Vasuji, are you there? Am I audible, sir?
Yes. Siddharth Vora.
Okay. Hi, Siddharthi. How are you?
Very good. Very good.
Great. Okay, Siddharthi. First of all, I welcome you on behalf of CFIMP for sparing your precious time and enlightening our members on today's subject and topic, which is very vast. And you have a versatile experience in your field. With this, I welcome you, sir. But before you start, it's my privilege to introduce you among our participants of today's program. Siddharth Vasuji is a head of the investment strategy and fund manager, executive director, and of the Proflin Life Blue Private Limited. Since joining in 2016, Siddharth Voraji has become an integral part of group's new age business initiatives. He spearhead PLs into the quantitative asset management space. Currently, he leads the quantitative investment strategy division and is also the fund manager of the group's. In addition, Siddharthi is also the executive director of the PLPL. Siddharthi has conceptualized and developed PL's flagging, PMS offering, and multi-asset dynamic portfolio. First multi-asset PMS that deploys quantitative technology for asset allocation. He is also the fund manager of PL's multi-strategy PMS, which is an active equity PLMS. Siddharthi is one of the youngest fund manager in India. Wonderful, sir. So that you have much spark and you have really explored the area. That's great. And brings in both the deep subject matter expertise as well as fresh landing business in school areas and insightful views and deep understanding of the capital market. Without taking much time, I welcome you, sir, because your profile is such a large, but I don't want to waste time because you are the youngest person in your field, much spark, much dynamic personality. With these words, with folded hands, I request you, sir, please enlighten our members with your words of wisdom. Thank you so much. Over to you, Siddharthi.
Thank you, Rituji. Thank you so much. So today, guys, I'm going to talk about a very new topic, which is becoming more and more relevant as time passes in the Indian investing landscape. So I'm Siddharth Vora, and I'm the fund manager and head of investment strategy at Prabhudas Leeladhar Group. And today I'm going to talk to you about quantitative investing or quant investing, which we believe is the more innovative and smarter way to make money in the markets for a sustainable period of time. So before getting deeper into the topic, I just want to lay the basic foundation of the subject. I think everybody who's part of the Capital Markets Conference has been a trader, an investor, been associated with the capital markets in some or the other, big or small way. And whoever has actively participated in the markets must have experienced multiple sort of emotions so far in their journey. Some emotions which were very thrilling and delightful, some which were very scary, some which were showing a lot of greed, some which were showing a lot of fear. So I think broadly, the big conclusion on this topic is that humans, all of us, are emotional beings, but we are also intelligent. We are very, very intelligent. We're the most advanced species on this earth, but we are also very emotional. But in investing, to make big, serious, sustainable money, we have to let go of the emotions and retain the intelligence. So, what is the science in today's world which helps us eliminate the emotions but retain the intelligence? We call it quantitative investing, which basically believes that human intelligence can be used and converted into processes, rules, systems, logics that make the decision, investment decision for us rather than we making the investment decisions. So basically, what quantitative investing is telling us is that you define rules, let those rules be the decision maker, don't make decisions yourself, because when we make decisions, we actually let a lot of our emotions come in the way. And that's not good for making serious money in the markets. So with that, we stand at a very unique time in India today, where all the world's data, all the world's latest technology, and India having the best IT and tech talent, everything is coming together and aligning in a very centralized way for us, which means 20 years back, we did not have high quality data. We did not have latest technology. Neither did we have superior talent in the field of technology that can combine these two things of talent and technology. So the data and technology. So today we have all the three guns firing for us. And because we are in such a unique time, we got to make the most out of this opportunity. It'll be very interesting to know that quantitative investing, it might be sounding like a difficult subject or a complex process, but it's actually a very, very simple and easy thing to understand. To give you a simple example, assume there are two people in the kitchen. Both have to cook a certain dish for us. One person is a very experienced chef who says that I don't need a recipe. I use my experience to make this dish. And the other person is a young, fresh, upcoming chef who believes in ensuring that every time he makes a certain dish, it tastes the exact same, which means he follows a recipe, he follows a process while cooking. And the process could mean how the ingredients should be cut, which ingredients should be used, how they should be cooked and how they should be processed, how the plating should be done. Every step of the process is well laid out, standardized, and tested multiple times to ensure that a high quality, good tasting, consistent looking dish is served to the final consumer. Now, in India, of course, the market is dominated by experienced chefs who rely on their judgment, their emotion, their gut, their intuition to make investment decisions. But we believe the world is heading towards a day and an era where systems and processes will actually triumph human judgment, will actually triumph only human subjective experiences. And that is why we believe in cooking with a recipe. We believe in investing with a system a process, and a well-defined set of rules, which are tested multiple times before we actually make the decision. So now in the world of investing, let's break down the whole process into 4 key areas. First is the inputs, which means what are the data points that I can look at personally, and what are the data points that my model can look at. So at a given point of time or on a given day, I could look at 50, 100, 300 data points to make a decision. But my computer can look at 50,000 data points to make the same decision. Who do you think will make a better decision? It's the computer, because the computer has processed many more diverse data sets in order to come to a logical conclusion. So my data is the starting point. Second step, once I have the data in place, how do I process the data? What is my strategy? What are the factors that I'm using? What are the rules that I'm building? How am I building in risk management? All of that comes in the second layer, which is the process. The third layer is the output. Output is simply telling you what to buy, when to buy, how much to buy, and when to sell. If all these decisions are given by the computer, based on the human insights given to the computer, we have a process that can make alpha repeatedly. And the last step is to continuously review, improve, and refine your strategy, your rules, your models. Once this whole process is followed repeatedly, this is what we call as quantitative investing. Now, the idea here is that every time we get into the markets, we go in with very little information about the subject, about a sector, about a stock. We go in with a lot of biases. If I've heard my friend telling me, okay, this is a good stock, this will become double in 1 year, this will become triple in 1 year, etc., I already have a bias in my mind that this is the stock which is going to do well. So now I look at that stock with that bias, with very limited overall information on that subject, which is why my decision making can be faulty. Or take another scenario where a senior industry person is recommending a certain security. Now he's done his research in detail to come to that conclusion. And just because he is buying it or recommending it, the others also feel that they should buy it. But what they are missing out is that to actually make money in the markets, only buying is not important. You also need to take that money home. You need to sell at the right time. And selling is a very, very difficult and complicated subject, because selling is not easy. And holding on to a security is even harder. So when you want to make money in the markets, you need to get all your 3 decisions right: buying, selling, and holding. But usually what happens, either we don't buy at the right time, we don't buy the right thing, or we don't buy enough of the right thing. Either of these 3 things could actually dampen the investment results. The other problem could also be we are not selling at the right time. And the third problem is we are holding on to the wrong stock when we should have already sold it. So these are some of the diverse complications we face in making investment decisions, and therefore in actually making investment returns. Now, what if there is a way where we can actually combine all the insights of all the intelligent people into a set of rules and processes that takes care of all the fundamental aspects of investing, the macro aspects of investing, the technical aspects of investing, the sentiment aspects of investing? We actually have a repeatable process that can ensure long-term investment success. So now, the important thing to understand, why is quant investing so relevant in today's world? Because the world is very dynamic, it changes very fast, but human behavior cannot change like that, which means to be successful, we need to be adaptive. Now, being adaptive is a very cool term, but it's not so easy to do, because investment styles are actually inherent to our nature. And to give you an example of this, I'll just tell you some simple things we do in our daily lives, right? So the way we behave with our friends, with our parents, with our children, with our colleagues, with our staff, everything changes based on the relationship dynamic. Similarly, the way we dress also changes based on the occasion, weather, place, etc. Which medication we take also changes based on the illness we have. One medication or one behavior or one form of clothes will not work in all the times, right? So we have to adapt. Now there is another aspect of adaptiveness which we cannot do. Assume, say, majority of the Indians say we know Hindi, we know English, and maybe we know a third language, but we don't know a fourth language. So if somebody is going to Russia, will we be able to speak in Russian? I don't think so, right? We cannot speak in Russian because we don't know that. So a language is an inherent limitation of humans that we cannot adapt immediately. It takes a lot of time to change your languages. Now, when we come to the world of investing, we cannot change our investing style. Style means somebody says, I'm only comfortable buying value stocks. Somebody is comfortable only buying high quality stocks. Somebody wants to make money only buying growth stocks. Somebody says, I don't care about any of this. I will chase the momentum. Wherever there is momentum, I will buy those stocks. Now, the problem is everybody has a particular investing style. Biggest fund managers, smallest fund managers, every fund manager comes with a style which they cannot change. But the market, unfortunately, doesn't respect your style. It doesn't respect your limitation. The market will change. And if you cannot adapt, too bad. It's your limitation. It's your problem. It's not the market's concern. Which means to make sustainable returns, superior returns across cycles, we have to be adaptive. But as a human, we cannot be adaptive in our investing style. And therefore, we rely on a quantitative approach. We rely on combining the human's intelligence with the machine's rigor, a human's insights with the machine's processing capability to actually eliminate some of these key issues. And we become then an adaptive investor. And therefore, to be adaptive, the only real way in today's world is to leverage all the technology, all the data, all the talent, and make adaptive models. And this is the work that we are bringing to the world today. And we definitely believe that quant is not only the future, but it's actually here to stay, and it's already here. And whether you look at American data or you look at data in India, it's very, very evident that quant investing is rising at a rapid pace or at an exponential clip. So the important thing to understand is, what are the real advantages of quant investing over traditional human investing? The first one is that we can process a lot more data with machines as compared to what we can do with humans. Therefore, we can take faster decisions. Secondly, we are flexible. We are not bent or restricted or constrained to a single investment style. So we are flexible based on the market conditions. The third is we are not emotional when it comes to investment decision making, because quantitative data-driven investment approaches takes the emotions out of decision making and therefore ensures that greed and fear do not impact our returns negatively. The other thing is, when we take a rules-based approach, we know what are the rules that are driving these decisions. So we know that this is not some art of stock picking, which is subjective and cannot be quantified. This is actually a very objective, transparent decision-making model. And the other thing is, because we are able to time our exits efficiently, we are disciplined in following the set of rules through and through, our downside risk actually comes down and returns start improving. And now, all of this is basically telling us that because humans can't multitask and computers can, we should rely on leveraging computers to do that. Because humans cannot guarantee accurate output every time you give them a task, but their subjective biases come in. We should rely on computers to make sure that every time we want a repeatable process, we get accurate output by computers. So what we are basically trying to say is, we don't believe in man versus machine. We believe in man with machine. We believe that the intelligence, insights, wisdom, experience of the humans should actually be translated and taught to machines so that they can execute better for us. And the reason why we really need this in today's life is everybody knows that I have to do these 5 things right in my life to be successful, to be healthy, to achieve my goals. But there is a big difference between knowing the right thing and actually doing it. So everybody who wants to be fit and healthy knows that they have to diet in a certain way. They also know that they have to work out every day. But knowing it is not enough. Are they able to follow it? It's actually doing the right thing. So because humans have emotions, either of procrastination or laziness, or simply the desire to relax and not work out, they postpone that decision of doing the right thing. But when we take the onus of the decision out of humans onto computers, we know that we can do the right thing and actually follow it. And that is why it is very, very important to use machines to improve our decision-making process. And usually, when we look at a track record of all the large funds in India or the large fund managers, it's very difficult to answer with clarity whether a good performance was by chance or was it by design. We cannot differentiate between the two. But in the world of quantitative investing, it becomes very, very easy and transparent to differentiate when the performance was by design, because all the rules and the granularity of returns actually lead us to the point where we can conclude that this performance was achieved by the design of the model itself. And therefore, there are a lot of merits on why we should consider this as the smarter and the better way of investing in a time like this when data, technology, and talent is available. Just to substantiate this with some more data, let's look at how USA, which is actually a leading indicator of how India evolves over the next few decades, suggests. So in America, we are seeing that on a 7-year basis, quantitatively managed funds have grown at an 18% CAGR. Actively managed funds have grown at only a 1.8% CAGR. And passively managed funds have grown at an 11.5% CAGR. So what this is telling us is that passive, which basically is saying, I'm not buying a stock based on anybody's decision. I'm simply buying the index. I don't trust a fund manager to go right or go wrong. And if he makes 100 decisions, he can go right 50 times, he can go wrong 50 times. But net, I don't think he will beat the benchmark. So forget that stress. Let's keep it simple. Let me just buy the benchmark. That is known as passive investing. Quantitative investing is telling us that you use rules to buy, sell stocks. And active investing is the field where you rely on a human's experience, judgment, and decision-making to buy the right stocks for you. So let's look at some trends here. On a 3-year and 4-year basis, what is evident is that actively managed assets are actually losing market share. They are degrowing. Passive and quant is rising. And this is a very, very important thing to understand in today's world, because India is also currently suffering from some of these issues that the developed world has suffered. The developed world has suffered with some of these issues mainly because efficient markets, as the markets become more and more efficient, you cannot really make alpha. You actually are a smart beta market rather than an alpha market. Fortunately for us, for the next 10 years, India is still going to be an alpha market. So we can do as much as we can to enhance our returns in this time period. Another important thing to look at is, as of 2019, 35% of all the assets managed in USA are actually managed quantitatively, as compared to only 24% of assets which are managed actively. And the balance, 35 plus 24, and the rest of it, close to 40% is managed passively. So this is how the numbers are stacking up today. And this trend is only tilting towards quant and passive. And I think in India also, we are following the similar trend. And there are multiple reasons that are actually driving this. The reasons are around cost of active management, the actual excess return generated by active managers, which is not very high, in most cases, and the reliability and repeatability of performance of active managers. So there are multiple reasons why quant and passive is actually gaining market share and active is losing market share. When we look at India, what data is telling us is that even when we look at a 5-year period, close to 95% of actively managed large cap funds in India have not beaten the benchmark. To give you a more simple illustration, 5 years back, if you bought a Nifty ETF, your returns would be in line with Nifty. But if you bought most of the actively managed mutual funds, 96% of them would have actually underperformed the benchmark. So the cost of investing in an ETF or a passive product is much lower as compared to active products, but the return is higher than an active product. And this is the biggest reason why India and the world is moving from active approaches to passive approaches. Because the choice and the decision-making process is very simple. You do not have to evaluate between 100 actively managed funds. You simply have to choose any Nifty ETF or Nifty index fund instrument, and you don't have to really complicate that decision. Now, if we look at how quant is growing in India, so if we've looked at data, say, from 2007 till 2022. Obviously, 2007 was the beginning, very, very early nascent stages. So the AUM was close to 160 odd crores. Coming back to 2022 today, I think the AUM is close to 25,000 odd crores. So the growth has been 150x. So the 150x looks astronomical, but it's slightly misleading because our base was very, very low. It's only in the recent times when quant funds have started doing well, and they've started attracting a lot of retail investors investing in them. And so the AUM is growing at a faster clip. But the idea is this market is no more a sub-1,000 crore market. It is a well-established industry, which is still nascent, but about to dominate. And a very, very interesting statistic here is the total AUM in India across all mutual funds is close to 40 lakh crores. Less than 0.5% of that is currently managed using quantitative methods. The early trends of how this space is about to evolve, it's telling us that anywhere around 10 to 15% of all the AUM in India will be managed quantitatively. And AUM itself will grow at a clip of 8 to 9%. So we are looking at a very, very large chunk of all assets in India managed quantitatively. So let us look at today's number saying 40 lakh crores and 10% of that, which is 4 lakh crores. Currently, we are at 25,000 crores. So we are looking at a 16x growth in AUM, just if the basic trends are held right. So this is a huge, huge opportunity for India and for all the Indian investors to actually use smarter, more sophisticated investment solutions to invest to create wealth. So far, I would like if there are any questions, from the audience, from any of the other panelists. It would be more interactive and nice to have some questions flow through at this stage.
Hello, am I audible, sir?
Yes, you are.
Yes, you are. Sir, it's a really wonderful section. I think you deliberated so well that no question and no queries there. Sir?
Yeah, sure.
Yeah,
So
sure. So
if there are no questions,
there are no
then I
questions,
can continue ahead.
Sir, please continue ahead. Right now, there is no question.
Okay, sure. So now that I've set up the broad context of what quantitative investing is all about, we're going to talk about 4 key points of how investors can actually make money using this, right? Because everything else was just setting the context. Now that you all are aware of something like this existing in the world, what do you do to really make money using this? So the four concepts that we are going to talk about today are: first, a dynamic multi-asset approach consistently beats a single asset approach for investors. The second concept is telling us that a dynamic multi-factor approach beats a single factor approach. A dynamic multi-style approach beats any single style approach. And the last one is that a dynamic multi-theme approach beats a single theme approach. Now, don't get confused and worried about these jargons. I'm going to simplify them for you all. So dynamic multi-asset simply means that as an investor, to make good, healthy money and sleep well through the year, through the ups and downs of the capital markets, you cannot have your portfolio in one asset. Whether your asset is real estate, whether it's gold, whether it's stocks, whether it's bonds, you cannot have one asset in your portfolio. You need to have a basket of assets to actually sleep well through the ups and downs of the economy, through the ups and downs of the stock markets. Why? Because when there is a risk-on regime in the world, where everybody wants to invest in risky assets, when there is more liquidity in the world, when the interest rates are down, equities do very well and make a lot of money for investors. But this does not last forever. We see the other side also. When the economy is crashing, interest rates are going up, inflation is sky high. There is a lot of fear and panic. In times like these, equities not just correct, they actually bleed and lead to a lot of capital erosion. In times like these, gold, bonds, these are some of the assets that actually protect your portfolio from a solid downside. And that's why you need all these kinds of assets in your portfolio to do their purpose. And to give you a simple example, look at the Indian cricket team. We don't have all defensive players. We don't have only fast bowlers. We need an attacking player. We need a defensive player. We need a strong captain. We need a good spin bowler. We need a right-hand bowler. We need all these kind of players to make a strong team. Similarly, to make a strong portfolio, you need all assets to do their bit. But again, just buying 4 different types of assets and sitting is not going to solve your problem. You need to be dynamic. And therefore, you need a strong captain like Dhoni to come in and make the decision. When should I go overweight risky assets? When should I go underweight risky assets? When should I make my attacking player come 2 down? When should I make my spin bowler be the first opening bowler of the session? These are complex decisions. And you need a strong captain to make these decisions for you. Sometimes most of your portfolio will be in gold and bonds. But at other times, you might not have any gold or bonds in your portfolio because it's not needed. So you have to be dynamic in adjusting your allocations to these asset classes to make serious money in the markets. The next thing is multi-factor as an approach. Why that is so important. So in all investment decision making, as I explained in the initial session as well, that you cannot make your decisions looking at one single factor. You need a lot of information, lot of different diverse factors to support it. What are factors? Let's simplify that. Factors are simply saying, I will look at valuation also. I will look at growth opportunity of a security or a company. I will also look whether the management is good. I will also look at the balance sheet strength. I'll also look at the debt of the company. I will look at free cash flows. I will also look at how fast the company is turning its debtors or inventory. I will look at multiple things to decide whether this company is good. Am I getting it at the right valuations? Is there a positive sentiment around this, etc.? So I need multiple factors to make a decision. If I were to do another way, if the company is growing really well, I will invest in it. If I chose to make a decision like that, I would actually not make too much money because there is a reason. First, if a company is growing very well, everybody in the market already knows it. Secondly, if a company is growing very well and everybody in the market already knows it, the valuations will be so high that all the good news is in the price, or rather, most of the good news is in the price. So the positive surprise is very, very low, which means if I choose a high growth company but ignore the valuations could actually come in and hit me. Secondly, if I say, okay, I don't care about the growth of the company, I just want to buy cheap companies that are very, very cheap. Now you need to understand, if a company is cheap, it is cheap for a reason. There are a lot of things about the industry, about the regulation, about the management that is not performing in the favor of the organization. And therefore, the company is trading very cheap. Now, if buying cheap was the only thing that made healthy investment returns, everybody would buy stocks that are trading at less than 10 PE, less than 1 PB, etc. But it's not so easy. So therefore, you need to look at multiple factors to get your investment decision right. The third facet that I'm going to discuss today is that a multi-style approach is very good as compared to a single style approach. And why is that? When we are looking at a multi-style approach, I'm basically saying that there could be times in a 10-year investment cycle that I need to behave like a value investor. There could be times that I need to behave like a growth investor. And there could be times where I need to behave like a momentum investor. But because I cannot do all of this on my own, because I have decided what my style is, I need to find a way to adapt across all these style regimes. And therefore, quantitative investing helps me do that. And as we go along in today's session, I'll actually show you all what are the different style regimes, how do they function, why are markets operating in these different style regimes, and how we can make the most of it. And the last thing that I want to discuss today is that a multi-theme approach is better. A theme is nothing but the smallest group of common stocks, which means automobile is a sector, auto ancillary is a subsector, and tire stocks are a theme. Financial services is a sector, banks are a subsector, but PSU banks is a theme. Like this, I could give you multiple examples of what constitutes a theme. It's basically a set of stocks that are correlated to each other and form a part of the smallest industry group. Now, why is using a multi-theme approach very important to generating superior investment returns? I'm going to discuss that also. So now I'm going to basically take you all through all these 4 different things, and this is going to form a bulk of the remainder of the session. If we have any questions so far, I'm happy to take them. If there are any questions on the chat, Rituji, do let me know.
Just wait for a second. I'm checking it. Just wait for a second, sir.
Sure, sure. Hi, are you guys there?
We are here.
Okay, shall I continue or do we want to take some questions before I proceed?
Sir, I'm checking. So you please continue.
Sure. Okay, so now going into the first real concept of the day is how dynamic asset allocation matters the most. It is by far the most important decision for you to make money in the markets across all time periods. So the simple illustration is when you look at returns of the different asset classes between 2007 to 2022, you will immediately realize one thing, that the winning asset class changes every year, which means in 2007, domestic equity with a 47% return was the winning asset class. But in 2008, it lost 52%. It was the losing asset class, and precious metals, which we call as gold and silver, was the winning asset class. Coming back to 2009, domestic equity was the winning asset class. Looking at 2013, international equity with 46% was the winning asset class. Precious metals with negative 18% was the worst asset class. Like this, we could see multiple examples of how different asset classes perform in different time periods. But for you as an investor to make money, we need to find a way to move in and out of these asset classes using a set of predefined rules so that in a certain cycle, you are positioned, your portfolio is positioned in the potentially winning asset classes and you are least positioned in the potentially losing asset classes. And if you can do this sustainably, you will be beating any of these individual asset classes over a long period of time. Now, the important statistic here is contrary to popular belief that security and stock selection drives returns or market timing will drive returns. The real answer is 91% of your investment returns are driven by your asset allocation decision. And only 4.6% is coming from security selection. And absolutely meager 1.8% is coming from your market timing decision. What this is telling us is that if you focus a lot on market timing to drive your portfolio, to buy stocks, to do derivatives, to do options, you're actually wasting your time and you're not going to take too much money at the end of it all from the markets. But if you're mature, sophisticated, disciplined, process oriented, then you will focus first on getting your asset allocation decision right, because you know that 91% of your returns are going to come from this. And to give you a few examples, in the 2020 COVID crash, didn't matter which stock you had in your portfolio, whether you had a Bajaj Finance, or you had a Reliance, or you had a Tata Steel, didn't matter. When the markets crashed, everything crashed by 40 to 70%. Which means if you were in gold or debt, or your asset allocation decision was right, you would actually protect your portfolio from this serious slide. Looking at few months ahead, coming out of COVID, if your portfolio avoided that slide with smart asset allocation, and you had a process that could bring you back into equities because equities globally became very cheap, then you would actually ride the entire rally post-COVID without losing much of your capital during COVID. And that is why this whole 91% number is working out to be true, where if you're in the right asset at the right time and out of the wrong asset at the right time, bulk of your work is done. To give you another risk return sort of example, what we are looking at is three things here: the blue bar, the yellow bar, and the dot. The blue bar is talking about returns. the yellow bar is talking about risk, and the dot is talking about risk adjusted returns. So as an investor, what do you really want? You want first a tall blue bar, second a short yellow bar, and third a high dot. When you get these three things, you're going to be a happy investor, you're going to be a peaceful investor, and you're going to be an investor who's going to take a lot of money out of the market. So let us look at few examples here. We are looking at conservative, moderate, aggressive, and dynamic style of asset allocation. And what is fairly evident here is all these styles, which are basically talking of a multi-asset approach, are much superior in their blue bar, the relation of the blue bar with the yellow bar, and in their dot ka height. All of them are doing much better than any of the single asset approaches. What are the single asset approaches? Large cap is a single asset approach. Mid cap is a single asset approach. NASDAQ is a single asset approach. Gold is a single asset approach. Government funds or gilt funds are a single asset approach. So ideally, for sustainable and respectful investment returns, only a multi-asset approach works through and through cycles for a peaceful conservative investor. Now, if we also look at the mood of an investor or the happiness of an investor through a scientific way, this is the kind of moods that an investor is likely to experience using a multi-asset approach as compared to a single asset approach. So the blue color is basically saying that an investor is going to be delighted. A green color is saying that an investor is going to be happy. A yellow color is saying that an investor is going to be moderate. A red color is saying that the investor is going to be sad. And a black color is saying that an investor is going to be extremely sad. These are the 5 states of being that an investor can experience during his investment journey. So what I have really painted here is that when you look at a multi-asset approach, bulk of the times you're either delighted or happy. Now, how do we define what is happy, what is delighted, what is moderate? It's very simple. When your portfolio is absolutely positive and relatively positive, you are delighted. Absolute positive means portfolio is up 15%. Relatively positive means Nifty is up 10%, but portfolio is up 15%. So I'm not only earning absolute returns, I'm also beating the benchmark of a strategy. So I'm delighted. I couldn't have asked for a better outcome. Happy means my portfolio is absolutely positive. I'm up 10%. Benchmark is up 12%. But I'm happy because my portfolio is up. Even though I've not beaten my benchmark, I've not lost money. So I'm happy. Moderate means my portfolio is down 5%, but benchmark is down 10%. So I'm relatively better off and therefore I'm moderate. Sad is my portfolio is down 10%, but the benchmark is down only 5%, which means I'm worse off. So I'm sad. But there is another state, which is extremely sad. What is that state telling us? My portfolio is down 10%, but my benchmark is up 10%. That is an extremely sad scenario for an investor to be in. So idea is to minimize the sads and the extremely sads and to maximize the happy and the delighted. So multi-asset approach does that very well across cycles. And when we look at multi-asset investing, we have a lot of assets to invest in, right? Everybody looks at equity, but even within equity, there are large caps, mid caps, small caps, sector funds, style funds, factor funds. There are multiple assets within domestic equity. There is fixed income. Even within fixed income, we have corporate bonds, gilt funds, liquid funds. Within international, we have US equity, emerging market equity, developed market equity, other international funds. Within precious metals, we have gold and silver. Within alternates, we have REITs and InvITs. All these assets perform at different times. In a rising, expanding economy, falling interest rates, equities do very well. In rising interest rates, high inflation, contracting economies, fixed income and precious metals should do better. So the idea is to move through these asset classes in an organized way to make sure that you reduce your portfolio's risk and maximize returns. And what does reducing your portfolio's risk really mean? It simply means that when equities correct 50% and you're an equity investor, your portfolio is going to go from 100 rupees to 50 rupees. In the next bull market, you're going to start with 50 as your base capital. 100 was your invested capital, 50 is your base capital. Now, if you are a multi-asset investor and somehow you are able to reduce this loss, instead of your portfolio falling from 100 to 50, if you are able to narrow that loss to say 100 to 90, in your next bull market, your starting capital is 90 rupees, which means you need to earn a much lower amount to first come back to 100 and then make returns over and above that. When your portfolio goes through that miserable state of going to 50, you actually need to earn 100% returns to not make any money. Just come back to your capital. Your starting capital is 100 and you're just coming back to that, but you need to make 100% returns to come back to that. But if you're starting at 90, even if you make 11% returns, you're back to capital. And that is the beauty of a dynamic multi-asset approach. Now, what are the factors that actually drive a dynamic asset allocation strategy? We've done a lot of research over the last 4 years, and we've narrowed it down to 5 key factors. The first factor is the macro. Macro factor means economic growth, inflation, global economy performance, unemployment, etc. How is the macroeconomic situation evolving? That will have a very important implication on equity markets, debt markets, commodity markets. Usually, we see that bond markets are the leading indicator of other markets. Stock markets follow the bond markets, and commodity markets are the last to react. To give you an example, if the outlook for the economy is bad and the inflation is high, bond yields will start rising. So the bond markets will peak out first. As the bond yields start rising, investors will be like, okay, I can make 7% on a risk-free rate. Why should I invest and take risk in equities? Let me start gradually moving my money from risky equities to risk-free or low-risk bonds for the same amount of returns, right? So gradually, equity markets start peaking out. But the lead indicator was the bond market. The third thing is, as interest rates go up, bond yields go up, equity market capital goes to bonds, what happens is economic activity starts slowing down. Companies start borrowing less. CapEx decisions are postponed. Overall consumption starts coming down, and therefore demand for commodities such as copper, aluminium, steel, crude oil starts cooling off. So the third impact is on the commodity markets. Now, what is very important to understand is that macro is one of the variables, but the macro variable impacts a lot of other variables, and we need to capture those. So the second variable is the value indicator or the value factor. A value is basically telling you that based on the current market conditions, which assets are cheap, which assets are expensive. Ideally, an investor should make better money or better returns when they buy asset classes that are cheaper because the risk reward is more favorable. Similarly, the third factor, which is very important, is the liquidity factor. Liquidity summarizes everything around bond yields, interest rates, money supply, FII flows, DII flows, monetary regime, interest rate cycles, etc. But the simple thing that liquidity as a factor is telling you Is there more infusion of money in the system, in the economy, in the financial markets, or money is being pulled out of markets? That is the only thing we want to know. If more money is coming in, flushing in, economy should do well, markets should do well, risk assets should do well. And when this reverses, money is being sucked out of the system, economy should ideally not do so well. Markets should ideally not do so well. And it is very important to understand the relationship between liquidity and its impact on risky assets, risk-off assets, and the economy. To complement the first three cycle components of macros, value, and liquidity, we need to support it with some more short-term indicators. So we look at trend. Trend basically captures the absolute and relative trend across the different asset classes to tell us that equities are doing well, but gold is doing better. So there is some economic or liquidity setup that gold is becoming the more preferred asset class. Similarly, equities are doing very badly, but bonds and gold is doing very well. So we need to capture the absolute and relative trend of all the asset classes to make investment decisions. The last factor is the risk factor. When we talk about risk, we want to look at risk appetite. We want to look at sentiment. We want to look at volatility. And we want to look at risk regimes. So the idea here is, if the sentiment is positive, it is good. But if the sentiment is euphoric, it is bad, because the risk of euphoric sentiment weakening is very high, and therefore investors in risky assets should be careful. Similarly, if the global risk appetite is strong, people are preferring risk assets over risk-off assets, it's a positive indicator. And when people are preferring risk-off assets such as gold and debt over risk-on assets such as equity, it's a negative indicator. So basically, we have built models that captures macros, value, liquidity, trend, and risk using multiple dynamic variables to decide how to do asset allocation across market cycles. And this is the long and short of why asset allocation is important, how to go about it, and how you will make serious money by following a multi-asset approach. Now, before we move into the next segment of equity investing using factors, I would again pause to ask if there are any questions or doubts so far.
Yes, Vasuji, there is one question. Am I audible, sir?
Yeah, but it's Vora. It's Siddharth Vora, not Siddharth Vasu.
Sorry, Vora. So there is one question from one participant regarding, does the growth of quantitative investing mean more need of financial engineers than just fundamental research analysts?
Yes, it's a very, very good question. So
that's why I picked this from 4 questions. I feel this is a very good question.
yes. So let's go into what is the scene, behind the scene story of quantitative investing. What are the kind of people you need to do this? So do I not need a fundamental analyst? Of course not. You need it. In fact, I'm a chartered accountant and CFA myself, and I actually am from the domain of fundamental analysis personally. But my team comprises of fundamental analysts, technical analysts, macro analysts, risk analysts, mathematicians, statisticians, Python programmers, data scientists, etc. So and economists, how could I forget? We have an economist as well. So we need all these diverse people who possess diverse domain knowledge to actually come together, bring their knowledge together in terms of rules, processes, indicators, factors, etc. And therefore, we need financial engineers, but we also need the macro guy, the technical guy, the fundamental guy, the math guy, the risk guy. And when all of us work together is when we can create something spectacular for investors. I hope that answers the question.
Okay, Siddharthji, the answer is very beautifully elaborated by you, which gives me a hint to say one thing. When you say we are statisticians, we are mathematicians, we are economists, we are management people, n number of economies in one brain. This is a merger of all economies.
Absolutely.
And Siddharth Vora I tell you one thing. I am in ICASA chairperson of Amritsar branch. And before that, I am taking the soft skill classes to groom the students for the corporate sector. I used to say one thing, we are not cardiologists, we are not pathologists, we are not neurologists, we are not persons who deal in medicines. We are not a doctor having dealing with one organ of the body. We are such a specialized persons who deal with the whole body, which is being very well explained by you that there is a merger of all economies in one brain. Thank you so much, Siddharth ji. Another question from another participant is application of PERT in wealth management, if any.
So, wealth management, I think the big role of the wealth managers is two things. Firstly, evaluating and making decisions on asset allocation. Second is evaluating and making decision on product selection. Quant can help in both. Basically,
Absolutely.
when you want to decide how to allocate assets for different clients, either you take the risk profiling way or you take the risk management way. When you take the risk profiling way, you're tailoring the solution to a client. When you take the risk management way, you're taking a different path. You're saying, I will decide to buy equity, gold, debt in a certain proportion, not based on your risk profile, but based on risk in the economic system, in the market system. Which means if you're an aggressive investor, but if my models or study or research is saying that equity is not the preferred asset class for the next 1 year, I will have a very low exposure to equity. But if you're a very conservative investor, but if my models or my research is suggesting that I can have up to 70% exposure to equity at this point of the market cycle, I will have a higher exposure to equity. That is basically taking a risk management focus to asset allocation as compared to a risk profiling focus to asset allocation. So quant definitely helps wealth managers in taking their asset allocation decisions. The second question was around product evaluation. I think as a wealth manager, you need to take a call on which mutual fund, which PMS, which AIF is good. Of course, quant uses and breeds on data to decide this. I do not take a call on which mutual fund or which PMS scheme is good, looking at either 1 year return or the narrative of the fund manager or the top 2 stocks in the portfolio or the last quarter's ranking. We evaluate rigorous data around risk, around returns, around Sharpe ratio, around volatility, around Sortino ratio, around multiple other ratios such as quarterly alpha, calendar alpha, etc., to decide whether this scheme is good or it's not good, whether it is suitable for my clients or not. And therefore, it is very, very important to have a quantitative approach to decision making in the field of wealth management as compared to a very subjective, non-repeatable approach. I hope that answers your question.
Siddharth ji, as you are an experienced and a very dynamic person in your field, keeping much expertise in the area, in your opinion, whether aggressive or conservative approach, which approach is the best for the investor?
Okay, so I think I answered that question
No.
in the second minute of
Both queries are answered separately. But if I ask which is the best option for the investor, he has to go aggressively or in a conservative manner. Which is your opinion?
Again, the answer leads back to one word: adaptive. When I have to be aggressive, when do I have to be conservative, when do I have to be moderate? Everything is based on my ability and desire that I want to be an adaptive investor. There are years in the markets where being conservative pays off, which is also we call it कि ये time पैसा कमाने का नहीं, पैसा बचाने का है. And then there are times in the markets कि you have to be aggressive. ये time पैसा कमाने का है. So if an investor is adaptive, he is smart enough to understand when to be aggressive, when to be conservative, when to be defensive, when to be attacking. So be
So-
dynamic, be adaptive. That is my answer.
So concluding part of these two terms is this: depending on the situation and the circumstances, we have to create the wealth, and wealth management is being done by keeping the adaptability approach.
Absolutely.
Chaliye. Next question is, how India shape up their funding requirement for ESG?
I don't think that's really relevant to my topic.
That's why I asked it to
Speculative
you.
investing, even though I might have some knowledge on ESG investing, I don't think I'm the right person to really comment on it. So I'll skip this one.
Chaliye. Another, you please continue. We have no more questions. Whatever is your session's part left, please continue, sir.
Sure. Okay, so the next section, we're going to talk about factors and how to invest in equities using factors. So factors are simply talking about every company can be broken down into multiple qualities or traits. We call them traits. One of the traits of a company could be its growth trajectory. Another could be its valuation. Another could be its momentum. A third could be its technicals. A fourth could be its dividend history, its liquidity, its size. So basically, we are not looking at companies from the lens of a business or from the lens of the management team alone. We are breaking down every business, every security into diverse factors so that all of them become comparable. To facilitate comparison, to facilitate data-driven decision making across multiple securities, what we really need to focus on is converting all of them into a comparable set of data points. So when we are actually able to break companies into factors is when we can evaluate them against each other. So to give you an example, when we are saying that this is a high quality company, right? A lot of people talk about high quality investing. We only invest in quality stocks, etc. It's a very subjective thing. How are you saying that this is high quality or this is bad quality? Quality is not an absolute measure. It is a relative measure. We use 25 plus parameters to decide which company is good, which company is bad, based on what? So first, we compare these 25 plus parameters to its industry peers, to its own history, which means I am saying companies that generate more than 20% ROE, companies that grow their PAT at 20% per annum, companies that generate free cash flow every 2 years or every 3 years, these are high quality businesses. Agreed. These are high quality businesses. But quality is not absolute. Quality is relative, which means a bank which is generating 15% ROE is a fantastic bank because banks generate 8-9% ROE in normal cycles. Current cycle, they are all generating very high ROEs because of a lot of asset quality improvement, solid credit growth, etc. But on a longer term basis, a bank generates 8 to 10 to 12% sort of ROE. So for a bank, 15% is a high quality bank. But if an FMCG company, which is not a capital intensive business, is generating 15% ROE, can I call it high quality? No, I cannot. FMCG companies are capital light, cash generating businesses. They better generate 30% plus ROEs. So if an FMCG business is generating 15% ROE, it's not a good quality FMCG business in our opinion. Other ways to look at this is, say, take a capital intensive sector such as cement or metals. If a cement company is generating 15-16% ROE, it's a fantastic business. If a cement company has a debt equity ratio of less than 1, it is a very good state of being. But if an FMCG company has a debt equity ratio of more than 0.5, it is a horrible state of being. So what I'm basically trying to tell you is quality is relative. Before deciding what is good, what is bad, compare it to its immediate peers, compare it to its industry, and compare it to its own history. Why history is important? Because if a company that was generating an 8% ROE is generating a 12% ROE today, it is a huge improvement. in the operating efficiency, in the capital efficiency of the business, and it must be rewarded for that improvement. Similarly, if a company was generating 40% ROE, but it is now generating 20% ROE, and we consider more than 20 being good, it must be penalized for reduction in capital efficiency or inability to invest the incremental cash flow at the same rate of return. When a company is not able to reinvest its capital at a high rate of return, it is not supposed to be rewarded positively for such a thing. So when we are taking a quantitative approach, we evaluate all these things and more and give a positive or negative score to all the companies for all the business traits on their quality, on their growth, on their volatility, on their momentum, on their valuations, by comparing it not just to itself, not just to its history, but also to its peers, to the broader market. And the important thing to note here is we assert that all these things are relative and have to be evaluated relatively. You cannot define an investment strategy saying companies that generate more than 15% ROE are growing faster than 15% EPS growth, have less than 0.5% debt, are good companies. No, you are not going to make money like that. When you find a company that is reducing its debt from 1.5 debt equity ratio to 0.5, it is going to give a multi-bagger return because there are two sources of returns. First, earnings growth. Second, multiple re-rating. These are the two sources of returns. Earnings growth is very simple to understand. Your EPS is growing. Some people track EPS, some people track operating cash flow, some people track free cash flow. Some measure of earnings must be tracked and a growth around that must be evaluated. But the other thing that is very important is the re-rating part. Now, re-rating happens in a few situations. Either your ROE is going up, or operating leverage is playing out, or competitive advantage is increasing, or longevity of growth is increasing, or you have a new avenue, new market, new product, which is leading to a new opportunity of growth. So either your growth size increases or your time of growth increases. One of these can lead to re-rating in multiples. Size of growth, time of growth. The other reason that could lead to re-rating is efficiency. Efficiency is basically margins going up, ROE going up, leverage coming down, operating leverage playing out. If either of these two, growth metrics improving, quality metrics improving, if either of these two happen, then a stock re-rates. Which means if your starting point is to find companies that only have very high ROEs, very low debt, you are not going to be able to make the second source of return, which is re-rating. You're only going to make returns through the first source, which is earnings growth. I hope I'm clear on this topic. And now to put some numbers around this. When we look at the various single factors that operate in the market, such as growth, value, quality, volatility, momentum, and we look at a multi-factor approach, what is very, very evident through color, through number, through data, is that using a multi-factor approach is going to give you much superior returns over a long period of time and across shorter period of time as compared to any single factor approach. So let us look at what happened between 2006 to 2023. I think the first proof of the pudding is bulk of the years of the multi-factor strategy are in green, which means it is outperforming all the other single factor and definitely outperforming the benchmark for most of these time periods. That is fairly evident. Now, when we look at this long period, what we are seeing is a multi-factor approach has multiplied your wealth by 116 times over a period from 2006 to 2023, which is basically roughly a 17-year period. Now, if you look at your benchmarks, that has multiplied your wealth here between 5 to 6 times. A low volatility investing strategy has multiplied your wealth 7 times. Quality strategy has multiplied your wealth 10 times. Value strategy 17 times. Growth strategy 24 times. Momentum strategy 42 times. Theme and sector focus strategy 75 times. So the simple idea here is that a multi-factor approach is better through the time periods and over the time periods for sustainable wealth creation. Another line chart to simply show the same thing, that over a long period of time, a multi-factor approach would outperform all the single factor approaches. And another thing to see is that factors operate in cycles, or the same factor doesn't work across the time period. So between say 2009 to 2015, we saw growth as a factor performing really well, but there were also time periods where growth underperformed. Similarly, when growth has been underperforming, we saw value as a style doing really well. So I think what is fairly evident is that when growth is performing, value doesn't perform. And when value is performing, growth doesn't perform. And I'll explain why this phenomenon plays. It's basically to do with economy and bond yields. And I'll explain how that really impacts cycles. Similarly, what is very important to know is momentum also as a strategy doesn't perform. It performs in some cycles, but it also falls miserably in some cycles. So you can't have a single factor approach to investing. And again, tying it back to the happiness index concept, we see that when we use a factor combination, investors tend to experience more longer periods of happiness and delight as compared to using any of the single factor approaches. And the idea is that as an investor, if we can maximize happiness, happiness maximization takes care of everything. Maximizing returns, minimizing risk, maximizing Sharpe ratio. All these things are captured in a single number or a single metric, which we define as the happiness index for investors. I think I've pretty much covered the whole concept of why multi-factor is relevant. And I quickly touch upon multi-style and multi-theme approaches as well. So when we're looking at style regimes, it is very important to understand what do I mean by regimes. So macro, when we look at macro, what are the different regimes? India is in a strong growth phase. India is in a steady growth phase. India is in a slowdown phase. India is in a deceleration phase or recession phase. These are macro regimes. We have commonly heard this, but we found a way to quantify this, put numbers to this, put this into data. Similarly, when we look at valuation, there could be a market which is highly overvalued. There could be a market which is highly undervalued. There could be a market which is fairly valued. Again, there are regimes of valuation. We could also look at monetary. When we are looking at monetary, we could see an expansionary monetary cycle, a contractionary monetary cycle, or a stable monetary cycle. Contractionary means money is coming out of the system. Expansionary simply means money is pumped into the system. Then we also have style regimes, growth style, quality style, value style, etc. And then we have risk regimes. Risk is basically telling us people are in the mood to take a risk. Everybody wants to make money. People want to take risk to make that money. Equities and risk assets will do well. It's a risk on phase. Similarly, everybody's scared. There is a lot of fear in the market. Nobody wants to take risk. People are fearful. It's a risk off phase. Bonds should do well. Gold should do well. Cash should do well. Liquid should do well. Right? Similarly, we have broken down investment style regimes for how to manage an equity portfolio through all this. So when economy is expanding, people are taking risk, there is a bull market, growth style should do very well. But when liquidity is expanding, is again a bull market, momentum style should do well. When liquidity is contracting, people are moving out of risk, it's a sideways market, value style should do well. People are uncertain about economic growth. People are uncertain. They are not certainly saying that we are in recession or things are going to hell. We are just uncertain. It's a low risk period. It's could be a bull market, could be a bear market, could be a sideways market. Quality should do well. And when economic contraction actually happens, when we are in a recession, it's a risk off period, it's a bear market, a low volatility style of investing should do well. So we've broken down the entire Indian market history into multiple style regimes. When you're seeing blue as the color, we're looking at value as a style of investing dominating. When you're looking at green as a color, we're looking at momentum and growth as a style of investing that dominates. When you're looking at red and orange as colors, we're looking at low volatility and quality as relevant styles of investing. So this is the long and short of how style regimes are operating. How can you benefit by using these style regimes to your advantage? And this is another pictorial chart of how we've broken down markets into regimes. And the important thing to know is this number here, 69.9, let's assume 70. 70% of your investment returns are attributable to your style decision, which means if you get your style decision right, 70% of your job is done. And that's why it is very, very important to have an adaptive approach to investing. And this again tells us in a very simple chart that multi-factor, multi-style approaches outperform single-factor, single-style approaches on a risk-adjusted basis, and therefore must be the preferred modes of investing or the preferred strategies for investing. The last session or the last concept for the day is about themes. How can we unlock the power of themes to augment returns for investors? So this is what themes look like, right? Automobiles, trucks, paints, casting, diesel engines, cement, printing and publishing, TV broadcasting, compressors, travel services, shipping, insurance, tea, coffee, electric equipment, hotels, resorts and restaurants, dyes and pigments, forgings, refineries, wood products. I'm just naming a few things that we have, like we call them our proprietary themes that we use to break down the entire market into close to 100 themes. Our second aspect after creating these themes is identifying which themes we want to stay invested in and which themes we want to avoid. Why is this so damn important? 95% of the times, 95% of the times, the top 5 themes in the market outperform the Nifty 500 on a quarterly return basis. And the alpha generated by getting your theme decision right versus the benchmark is close to 25% on average on a quarterly return basis. What we are really trying to say in a very simple way is, if you choose the worst stock in the best theme, you are more likely to make solid returns as compared to choosing the best stock in the worst theme. Which means that, for example, investors over the last, say, 1.5 years thought IT was a sector that should do very well, and they got the sector called wrong. Now, even if they bought TCS or Infosys, which are considered to be the best stocks, the stalwarts, the legends of the industry, they would not end up making any serious money. But if they chose an ignored sector, such as defense, defense has been in the limelight because of the government push for reducing imports, indigenization of defense, and making India a huge export economy for defense equipment. If somebody understood this theme and kind of ignored that, okay, this sector has been a PSU sector, it's not been so capital efficient, they are dependent on government orders, they are dependent on government for recoveries, very stretched working capital cycle, lot of debt on the balance sheet, they take a lot of time to recover money from the government, so the debtor days are very high. Let's ignore this sector. It's not seeming like a palpable sector to start with. If investors chose defense as a sector to ignore, they would actually miss out on a very, very solid opportunity to make money in an otherwise sideways market. So what I'm trying to say is, if you pick even an average stock, but you got your defense theme right, you would make solid money in this period. But if you chose the best stock, but if you got your theme wrong, saying IT, because of fears of global recession, US economy coming down, lot of firing happening in the tech sector, high attrition rates, lot of wage revisions, basically a lot of things painting at an IT sector, seeing gloomy times ahead, at least for the near term. 10-year basis, IT is superb, agreed. Near term, 1, 2 year, 3-year challenges, possible. So the idea is you need to get your theme right. Stock selection becomes less relevant when you get your theme right. And 72.5% of returns are driven by your sector or theme selection decision. And it is very, very important to understand this. To wrap this whole thing up with data, again, when we look at a quarterly set of data, we see that investors experience a lot of various moods, sometimes very happy, sometimes sad, sometimes extremely sad. But the moments investors start looking at a 1-year return, 3-year return, 5-year return of their portfolios, they become more and more happy, more and more delighted, and the sorrow starts reducing. So yes, use quantitative approaches to investing, but also try to understand that how to evaluate your portfolio, on what time period to evaluate your portfolio. And to wrap up everything that we discussed in today's session, getting your asset allocation right, very important, drives 91% of the returns. Getting your theme selection right, very important, drives 73 odd percent of returns. Getting your style selection right, very important, drives 70% of the returns. Using a multi-factor approach, which is better than a single factor approach and beats the benchmark 80% of the times, very important. And finally, don't use a single asset to build your portfolio, use a multi-asset approach. Don't use a static approach to build your portfolio, use a dynamic asset allocation approach. Don't use a single style, be dynamic and adaptive across styles, because the market doesn't care what your style is, it cares about what its own style is and how that is evolving. So understand what is driving style regimes and try to adapt. Third thing, don't focus your portfolio on 1 or 2 sectors, have a spread of sectors and be dynamic in moving in and out of sectors. And the last thing is use a set of factors to make decisions. And if you can't do all of this on your own, there are professionals like me, like my organization, who can professionally manage money for you using these quantitative techniques, these quantitative strategies. And we run our own PMS, which is basically a multi-asset strategy, which is known as multi-asset dynamic portfolio, and an equity-oriented strategy, which is known as Aqua. We run these 2 strategies so that investors such as you all or your clients can actually benefit from all the work we've done in the field of combining fundamentals, technicals, macros, risk into quantitative investing strategies. So that's pretty much everything I wanted to talk to you guys about today. Thank you so much for attending this session. And if anybody wants to reach out to me, I'm just putting in my email ID in the chat box here. Rituji,
Yes,
that's pretty
yes,
much it
sir.
from my side.
Yes, sir.
If
Yes,
there are
sir.
any questions, I'm open to take them.
No questions further, sir. But one thing, the concluding part by you is very good. Don't put and select one product, select in the different and multiple factors.
Exactly.
Because economy does not care you, economy cares itself and involve itself in their own particular way. This is the right approach. As we already read in so many times, don't put all the apples in one tray. Am I right, sir?
That's absolutely right.
So thank you so much. Is there Mr. C.A. Kotha S. Srinivasji is there? I think he has not attended the program. Otherwise, the concluding remarks will be by Mr. C.A. Kotha S.N. Srinivasji. So, Siddharthji, on behalf of the whole team and the CFIMP, I extend my sincere thanks to you for sparing your precious time and enlightening our members with your words of wisdom. Thank you. Thank you so much, sir. And kindly share the PPT with our technical team so that they can share it with the members for their better understanding and the concepts clarity more, sir.
Okay, thank you so much.
And you are such a dynamic young personality. Keep moving.
Thank you so much.
Bye. Take care.
Okay, bye.